I'd like to welcome our new sponsor, Rothschild Capital Solutions. Rothschild is a commercial investment banker and direct lender. The company targets well-located assets for value-add investment primarily in the Midwest and the Southeast. Rothschild is positioned to invest up to $35 million per deal. They may be just the partner or lender you've been looking for to turn your deals, even the most aspiring, into reality. Need capitalization beyond a debt financing loan? Rothschild gives you a full set of options: JV equity, bridge, preferred equity, mezzanine, development and construction. What do you need? The chances are Rothschild can provide it, as well as the experts to make the deal real. Click on the banner below the show to contact Gary Williams now. You've got the deal, Gary's got the backing you need. Click now. Hello and happy Wednesday, October 28th, and welcome back to another exciting edition of Rate Desk. I am your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, going to the markets today. It's a spooky time of year and the markets are spooked. They are all down. All three indices are in the red. A lot of it has to do with COVID news, potential shutdown. A lot of questions kind of out there now of what this fall and winter is going to look like for the economy. So market is reacting to that. Subsequently, we have seen the 10-year yields tighten up from where they were last week. We now have a 7 handle back on them, so 0.78 is where they're trading at today. Crude oil, of course, took a hit. Again, you know, the fears of the stay-at-home oil usage is going to go down. So we're now seeing that number at a $37 barrel range. Expect that to come up if we get some good news. Obviously, if we get a vaccine, that's a game changer for a lot of what we're seeing in the market because it's just so sensitive to that data currently. Jumping over to the multifamily interest rates, pretty good news there. I mean, relatively range bound where we were last week. We're seeing the 223F fixed rate. We're still seeing that trade at about 2.28 today, fixed for 35 years. That's mid-range, and we're looking at the 40-year fixed rate at about 2.78. That's fixed for 40 years. So still very attractive, very low interest rates. Jumping on over to the agency desk, also still very attractive, looking at probably around a 290 at the low end there for the Fannie Mae 10-year fixed rate. And for Freddie Mac, we're probably looking at 3%, although you could possibly get under that again with some of the affordability metrics and or the green sustainability metrics could get you under that 3 handle on the Freddie Mac debt. So still historical lows in the debt market. We're seeing historical volumes of loan applications. We've talked about that before in previous episodes. That trend is continuing. Still a very good time to lock in fixed rate long-term capital at just historically low interest rates. So take a look at your portfolio for that. Now, in other news, what I want to speak with you about today, just a couple concepts. You know, one thing that's been coming up recently, describing real estate investing, commercial real estate investing to a broader based community to get more people involved and interested in the idea of investing in 5 units and above commercial real estate. You know, one way to think about it really, and I want to fact check this with you all in the audience, but this cash on cash return, you know, it's thought of as the least speculative way to look at a real estate investment. Of course, it's not the only way. We all know that projecting the future is part of what real estate investment historically has always been, looking at all the different forms of benefits from taxes to appreciation and all of that, the reversion, the sales price, if there's a compression on cap rates, all those factors go in. But boiling it down to something simple, can we just look at that cash on cash return? How stable is that today? How reliable is that? You know, one number I heard through a bar at a recent investment conference is around 8%. 8% cash on cash. I've heard lower numbers from larger institutional buyers, but I'm wondering, is that the right sweet spot for the market today? Are you looking at a terminal ROI of 18 to 20%? You know, there was a time when I was doing a lot of models and they were definitely pushing the envelope on the higher range of the 20%. Has that come down? Now, all that to say, compare that to your other forms of investment. Remember, commercial real estate, you're looking at investment compared to other vehicles. Okay, the dividends on the S&P 500 have been 1.7%. We know that the US Treasuries have been 2 times less than that, roughly, right? So what other options do you really have currently, and how attractive are they in comparison to commercial real estate investing? I spoke with a private equity fund manager that focuses on social impact investing. He happens to use opportunity zones. It's one of the tools in the tool bag that they use for their investments. He was saying that those preferred distribution returns are about 5.5%, which sounds lower when you compare it to a market rate 8%. But remember, this is social impact investing. This firm, and what I like about it, he's going to be on a future episode of Money Talks I want you to watch. But what I like about it is they have quantitative and qualitative measurements to determine social impact. Okay, I'm talking to you about this because everybody in housing, all of the housers, we are involved in social impact, whether you intentionally are or not. Everything you do, the units you build, how you develop your properties, where you market them, everything has an impact on a community. It's a people-oriented business, and I know you know that. So there is a social impact component to it as well. Are you measuring that for your own properties and for your own business in a meaningful way? In other words, if an outside audit firm came in and said, show me what you're doing for social impact, can you produce something that shows them what you are doing from a social impact perspective? I think it's important. Investors have demonstrated there's an appetite for this type of investing. You will read about and hear about ESG with Wall Street fund managers. These are so-called, funds that have more environmental, sustainability, green energy efficiency, etc. In reality, are they really doing something meaningfully different? I don't know. The problem with those is that they're large funds, they're invested in lots of different things, and you really have to go and look to see what is the actual social impact. The nice thing about real estate investing in this way, if you're targeting social impact, is that it is a real investment. In other words, you can drive by it, you can go see it, you can really look at it. So I encourage you to develop metrics. Come and watch this episode. It's going to be very exciting to hear what this social impact private equity investor is doing, specifically in real estate. Mostly they are focusing on real estate for their impact investing, which I think is fantastic. I like to see that. Also, I want to mention to you, coming up very soon, you're going to see an episode on Money Talks where I interviewed a former Goldman Sachs trader about negative interest rates. Boy, it was a really, really good discussion, and I learned a ton. We also talked about SOFR versus LIBOR and just some of the changes we're seeing in the market today and what are some good investment vehicles, institutionally speaking. It's another great episode, to make sure you come back to Yield Pro TV and check that out. That's all I have for you all today. I hope everybody has a great and safe Halloween. Thank you for tuning in to another exciting edition of Rate Desk. I am your host, Michael Thomas, signing off.